We'll now turn to a discussion of behavioral finance. In other words, sort of the effect of psychology of investors on the markets. And you may wonder what connection this has to efficient markets, but there actually is a pretty readily available one. So remember, the efficient market hypothesis supposes that market prices should reflect all available information. And therefore prices should respond to new information quickly. There shouldn't be predictability. And therefore, if we do find a substantial body of evidence of anomalies and abnormal returns, is this definitely a contradiction of the efficient market hypothesis? Well, behavioral finance actually offers an alternative explanation. And this is sort of based on psychology and how common psychological factors across all people affect financial decision-making in particular. And the finding from behavioral finance, put broadly, is that there's actually predictable biases in human reasoning from psychological evidence. And what that means is that there then will be systematic, I should say, biases in people's investment processes because, remember, the markets are a human creation, and therefore they will exhibit the biases that their creators possess. This may mean that prices could actually be not rational, not necessarily because the market is inefficient. It could just be that market participants are themselves not fully rational. And this irrationality of market participants really broadly falls into two categories. The first is information processing, the idea that investors can simply make mistakes in estimating the distribution of asset payoffs. Even if they have access to correct information, they'll simply get to the wrong conclusion in it because there's something wrong with their approach. And this is something that can be, of course, fixed because a cognitive approach, a cognitive error, can be remediated. And the other big category, behavioral biases, is, in a way, perhaps the more serious one. That one suggests that even if you know all the data and you can make all of the correct judgments based on the data, you might still make the wrong decisions simply because of sort of systematic errors in human psychology. And that, of course, then can't really be fixed either readily or at all if it's sort of a hardwired function of our behavior. And then, of course, the follow-up from that is, well, if people are so irrational, why don't arbitrageurs, who perhaps are the most sort of sophisticated among us and the ones most able to rationally reason through what's going on with prices, why can't they just make all the money in the world and exploit all of this rife irrationality and make prices still efficient, even if market participants are inefficient? And the answer to that lies in limits to arbitrage, which also goes hand in hand with behavioral finance. So let's actually discuss some of these behavioral biases, and then we'll move to a discussion of limits to arbitrage. The first of these is overconfidence. As we briefly touched on, all active managers think they are better than average. All drivers think they are better than average. Generally, people will overestimate the reliability of their knowledge. And this really extends to all areas of human endeavor. Almost all people are on some level vulnerable to this. So what does overconfidence, this idea that we will overstate our competence to ourselves and perhaps to others, what effect does this have in finance? Well, First of all, this probably means that an overconfident portfolio manager or analyst will overweight the information that they collect relative to others if they believe they are more competent than the average other analyst or portfolio manager. That means that then people will conclude that, well, if the average person can't outperform the market and they buy into the academic evidence that shows this, they might still say that, well, that's fine, I'm simply better than average, I can still beat the market. And that's also the reason that an active manager will still perhaps use to propose why they should manage money, even if results show that the average active manager doesn't justify their fees. And furthermore, overconfidence leads to this idea that is sometimes called resulting, otherwise more sort of in detail defined as interpreting your own view and justifying your earlier decisions. Overconfidence will essentially just lead you to say that, well, when you had good performance, that was because you had skill. In other words, if you got a market-beating return in the year, it wasn't necessarily because you just got lucky. It was because you knew what you were doing and you chose the course of action that led to the superior performance. But the flip side of that coin is that when you have a underperforming year and you make losses, that's when an overconfident portfolio manager or analyst will say that, well, that was just a run of bad luck. It wasn't anything that I did. And this sort of asymmetry in response will essentially cause market participants to over-accentuate the times when they have done well, de-emphasize the times when they have done poorly and refuse to learn from them, which then perpetuates underperformance. So what's the problem then? Well, it literally means that it will not only cause people to initially think they can beat the market even if they can't, but it will cause them to keep thinking so, because the incidences where they didn't beat the market would simply be ascribed to bad luck. And the times, even if they're rare, when they did, those would be considered evidence of true market-beating skill. And furthermore, then, if one over-relies on one's own data collection and under-emphasizes the data collection of others, that probably means that one will overtrade and under-diversify. In other words, you will make more decisions than you perhaps should if you think decisions that you make are more likely to be right than wrong. And since everybody has sort of a limited information bandwidth, if you prioritize information that you did collect over the information that you could have perhaps bought from a research vendor, that means that you will then, by sort of limited bandwidth, be forced to be under-diversified. A common finding in behavioral finance, which, like behavioral psychology that underlies it, is based on experimentation, finds that people will trade too much. And again, this is because they believe their actions to be more right than average, and therefore there's more reason to take these actions. And overtrading is bad primarily just because it increases your transaction costs, and all costs are a drag on portfolio performance. But also they don't actually contribute anything, because even if you don't have above average skill, let's say you have perfectly average skill, in each trade is as likely to help you as it is to harm you. Well, then trading more is not going to do anything but run up your costs. So when we look at the relation between gross return and turnover, turnover being sort of how frequently you trade, we see that if we sort of look at different investor portfolios, the gross return of the investors doesn't really seem to vary very much at all, even if there's some that have very low turnover. and some that have very high turnover. But then, of course, the net return decreases because all turnover comes at a cost of paying some commissions or other trading costs like bid-ask spread and slippage that actually does reduce your net investment return. And therefore that means that the average individual, even if they might earn higher gross returns than an S&P 500 index fund, they'll earn lower net returns because of this drag from overtrading. Obviously, the S&P 500 index fund might not trade very much at all. It might rebalance periodically, but there won't be unnecessary trades dragging on the portfolio, such as paying the bid-ask spread, that will drag down the performance of the individual. Now, another drag that overconfidence introduces on portfolio performance is that people will then overtrade simply because they see a pattern that isn't actually there. For example, you might look at a price pattern like this, and you might say, okay, this is a clear uptrend, this is a clear downtrend, this is a clear downtrend, and there's experimental psychological evidence that finds people finding patterns like this even when the underlying so-called return series is actually programmatically generated. In other words, there was no possible economic meaning to these price fluctuations because the prices were fake. But it's sort of in our nature to look for patterns, and this will sort of come back to our discussion of the pros and cons of technical analysis, which is all about looking at patterns in price movements and what you can learn from them and, well, perhaps what you can't. Now, overconfidence is maybe sort of the big information processing type of error. Remember, that's sort of a cognitive bias, a flaw in your reasoning. So your reasoning may be correct. You may be coming to the right conclusions. You are simply overweighting them due to overconfidence. Or even worse, of course, you might be overemphasizing your erroneous conclusions. But others are forecasting error. So for example, people will overweight recent experiences and underweight prior beliefs. This is by some really famous psychologists, Kahneman and Tversky, from 72 and 73. They actually find exactly this, and that sort of explains why high PE firms will often end up underperforming. Because essentially recent performance has been high. That causes people to get really excited about a new exciting growth firm. They massively overpay for it because even if prior experience suggests that, well, these types of unicorns don't come around terribly often, that's why they're called unicorns after all, but this is the one. People overweight a recent spate of positive performance. They will then pay inordinate amounts for this firm, driving up its PE ratio, and then, perhaps unsurprisingly, lead to underperformance when whatever expectations they had in mind don't materialize simply because they were too focused on the recent growth and underemphasized what the broader historical track record suggests is possible for corporate growth. And the flip of that is conservatism, which suggests the opposite, that sometimes investors will actually be too slow to update their prior beliefs and underweight new experiences. This can, of course, then lead to an underreaction and therefore to price momentum, such as, for example, around earnings announcements, where some truly good news about the firm might not cause people to change their minds about the firm sufficiently right when the news is released, and lead to an underreaction that gets corrected over time. So if this sort of sounds like contradictory, well, I mean, in a way, these two biases are. You can't probably have both an underweighting of new experience and an underweighting of your priors at the same time. But what you can do is you can, at different times, inappropriately weight one or the other, even if both are estimated correctly. So then it's sort of up to the individual self-reflection to try to identify in what cases they might be underweighting the prior beliefs, in what cases they might be underweighting new experiences, and that's the type of information processing error that could potentially be corrected. Another common set is sample size neglect, the idea that people will extrapolate unreasonably from small samples out to generalize into the future. This is common in periods of market euphoria, where investors will overreact to any good news, bid up prices unreasonably, and then, of course, result in a price correction sometime down the road because prices were inflated to an unjustifiable level. And related to this is base rate neglect, so sort of more of this discussion of how do you treat your recent experience versus your priors. The idea that people will lump investments into categories without incorporating the unconditional probability of that category. So what does that mean? Well, a good example of this might be assets with lottery-like payoffs. In other words, assets that can earn really big payoffs, but perhaps very infrequently. And those are the ones that one would be most harmed by base rate neglect in, because one sort of forgets that the probability of winning this lottery is quite low, and just focuses on the fact that if you do win it, well, then the payoff is very high. And that leads to overbuying of lottery-like assets like options, lottery-like firms like biotech stocks or firms near bankruptcy, precisely because the investor may think that, well, I know this firm is actually going to reach this high payoff. I'll forget the fact that very few do, whether it is passing a phase 3 FDA trial or whether it is surviving the bankruptcy process, in other words, not actually going into bankruptcy or somehow coming out of it with positive recovery for the shareholders, or having an option that expires in the money, whereas most don't. All of these are examples of base rate neglect because the investor focuses on the payoff and forgets the probability of that payoff, therefore overpaying for the asset.